Hi, welcome to Weekly Update. On Monday, the Chinese GDP will be released. The Chinese economy experienced slower growth in the first quarter of 2023 due to implementation of several COVID-19 lockdowns, which disturbed economic activity. The GDP growth rate of 4.5 fell short of government's target of 5.5% for 2023. However, the government has since eased some of the lockdown measures, and it is expected that the GDP growth rate will rebound in the second quarter. The impact of the China GDP annual growth rate on the market and the Chinese yuan is mixed. On one hand, a GDP growth rate that is weaker than expected could negatively affect investor sentiment and lead to a sell-off of Chinese assets. On the other hand, a weaker yuan could enhance the competitiveness of Chinese exports, providing short-term support to the economy. On Tuesday, US retail sales data will be released. Surprisingly, US retail sales increased in May 2023 despite the rise in inflation. This strong retail sales data indicates that consumer spending in the US remains resilient even in the face of higher prices for goods and services. The impact of US retail sales on the market and the US dollar is positive. Strong consumer spending is an indication of economic strength, which could support the stock market and the value of the US dollar. On Wednesday, we will receive the inflation rate for the UK. In May 2023, the UK inflation rate remained steady at 8.7%, the same as the previous month's 30-month low and slightly higher than the market expectations of 8.4%. The high inflation rate is a major concern for the UK government as it puts pressure on household budgets and could potentially result in a slowdown in economic growth. It is anticipated that the Bank of England will raise interest rates again in July to counter inflation. The impact of the United Kingdom inflation rate on the GBP and the market is negative. High inflation acts as a drag on economic growth and may lead to sell-off the UK assets. Additionally, the GBP may face downward pressure as investors seek to relate their assets to countries with lower inflation. Another significant data point on Wednesday is the euro area inflation rate. In June 2023, the euro area inflation rate decreased to 5.5%, down from 6.1% in the previous month, and slightly below market expectations of 5.6%. The decline in the euro area inflation rate is a positive development as it indicates that inflation is beginning to be brought under control. However, the rate is still relatively high and European Central Bank is expected to continue raising interest rates in the effort to reduce inflation to its target level. The impact of the euro area inflation rate on the euro to the market is mixed. A lower inflation rate could support the euro in the stock market. On the other hand, the ECB's tightening cycle may have a damping effect on the economic growth and lead to a sell-off Eurozone assets. Remember to stay informed with CH markets, and I'll see you soon.